All right, I think we are ready to start. Hi, everyone. My name is Serena, and I lead up the analysis team here in APAC. Joining me today are a team of Vortexa's finest analysts. So we have David, our chief economist. We have Ross, our senior fuel analyst. Emma, our China market specialist. Jay, our lead crude analyst. Aman, our crude analyst. And last but not least, Dylan, our freight analyst. Just some housekeeping rules before we start. This will be a 1-hour session with 45 minutes of presentation and a 15-minute Q&A. Now, if you have any questions for us, feel free to pop it inside the Q&A box and we'll be happy to answer your questions at the end of the session. Now, we will also be sending out a copy of the slide deck and this recording after the session for your reference. So I think we're ready to start. Now, if I were to describe the world and sum it up, describe the year and sum it up in 3 points. First of all, the year started where the oil markets witnessed a demand recovery as the world emerges from the COVID-19 pandemic. But this was very quickly disrupted by the Russian-Ukraine invasion that upended the global trade flows. And as we entered the second and the third quarter of this year, the oil market started to see a severe tightening and it tested refining system limits. But while all this was happening, the rising inflation, the rising oil prices started to squeeze and erode disposable incomes of people all over the world. And there we are now, right at this stage where we're starting to see global trade flows, price signals starting to signal a decline and a softening of the global oil demand. So in today's session, what we'll be aiming to do is to explore a little bit more about the outlook of 2023, specifically the oil supply as well as demand, looking at the current as well as the unfolding developments around the Russian seaborne oil exports, and last but not least, what's going to happen to China's oil demand as well as exports going into next year. So without further ado, let me pass the time to David.
Thank you. So, following up on what Serena just said, I think we are pretty likely to either already be in a recession from a global level point of view, or we're going into one. We can see this already on the oil import side pretty clearly. So if we look here on the left-hand chart, for example, we see in the red line this year's value. And you can see the last 3 months we have fallen below the blue line, which is the average from 2016 onwards, the seasonal average below last year's level, the yellow line, and also in this range we are rather in the lower half now. This is basically global light distillate imports, so gasoline, blending components, and naphtha. The same similar story is true on the fuel oil side as well. 2 out of the last 3 months have seen seasonal low levels, so we're even below the historical range here. So what we see on this slide overall is simply demand weakness both on the top and of the bottom of the barrel. Now, of course, the key interest in the market is right now on middle distillates and in particular on diesel. And that we see on the next slide. We look there at 2 markets in the Southern Hemisphere. We have pointed out again and again over recent months how much basically the Southern Hemisphere has contributed to the strength in the global diesel market. If you look at the spike in the red line, you see in both cases here on the left-hand chart, we see the South Atlantic. So this is South America, East Coast and West Africa. In the right chart, we see the wider Arabian Sea. That's the Middle East, East and South Africa and West Coast India. So in these markets, for example, we have seen a clear spike in imports in September. And these levels, and already partly the months before, have been massively above the seasonal range. The question was basically all the time whether all these imports are simply meeting current demand, as it would usually be the case, or whether it could be that there has been some type of stock building going on by consumers around the world, simply fearing that the winter would get very difficult, very expensive in terms of pricing, because Europe is depending on Russian supplies, is depending on Russian gas supplies. So a lot of people were fearing, and there's still certain concerns, but they have generally abated, I think, quite significantly in the European market. that there would be an energy crunch. But what we can see is basically now over the last 2 months, the imports of diesel in these two markets, but we have seen a similar pattern in other markets as well, have come down quite significantly. So also on the diesel side, there is a certain easing in import demand. As said before, there may still be some upside for the winter months, but I think can perhaps already say at this point of time that we say limited additional upside for the diesel market down the line. Now, I've been talking a little bit more about Atlantic Basin global markets. Savina, how is the situation in Southeast Asia specifically?
Yes, David. So it is very similar to what we see for the rest of the world. And on the left chart, we see Southeast Asia's clean product imports. For the first 10 months of this year, imports have been relatively robust despite rising oil prices. And that's because the government have been very generous with their subsidies, keeping the inflationary pressures on consumers very minimal. But in the recent months, we started to see countries pulling back on their subsidies and allowing the fuel prices to rise. And because of rising inflationary costs, we started to see demand slowing and softening. And what the left chart really shows is if we remove Vietnam as an outlier, potentially, the red dots is the Southeast Asia, excluding Singapore, Malaysia, and Vietnam. In the most recent month, the imports into Southeast Asia was at the lowest this year. And if we look at the wider Asia region and particularly focusing on LPG and naphtha imports, it has remained relatively soft off the back of lackluster demand coming from the petrochemical sector. The cracker margins have remained relatively soft. And a lot of the new cracker that were supposed to be started up in China this year have delayed their startup to next year. Some of the existing ones that were shut down for maintenance in Northeast Asia are extending their shutdowns to at least the end of the year. But one bright spot for the LPG market is in terms of India as well as Indonesia. These two countries have ratcheted up their imports of LPG, particularly for the residential sector as well as the industrial sector, to a certain extent because of the high LNG prices. But overall, from a petrochemical demand perspective, we expect that continues to remain soft entering into next year. Jay, what's happening on the Atlantic Basin front?
Thanks, Serena. So with the Atlantic Basin, what we've seen in the past few weeks is this huge reversion away from backwardation and into contango. And so on the right-hand side chart, what we see is both the Brent and WTI futures, the time spreads, have flipped into contango, even if it's mild contango at this stage. Now, why is that happening and how can we see that in our data? So that's what the left-hand side chart shows. And so there's two facets to this. One is the trends that we see with Atlantic Basin crude on the water. And two, it's the trends that we see with European onshore crude storage. So starting off with crude on the water, we've seen a huge increase in crude on the water in the second half of this year. And there are a few factors driving this. So one, crude exports from the Atlantic Basin have really picked up. There are a few countries which have been driving that, such as Brazil, Guyana, the US as well. However, it's also the case that more crude has been traveling further. I'm sure we'll talk about this in more detail, but there's been more crude traveling from the Atlantic Basin to China. So that's really picked up the crude on the water numbers. At the same time, while all of this is going on, we've seen a much more structural, steady increase in European crude inventories, and that's been happening since the start of this year. So when we put both of these together, naturally we'll see pressure on prices, and with that pressure on prices has come this flip away from backwardation into contango. So with that in mind, I think it makes sense to look at a kind of quick summary of what we've talked about in the past 5 slides or so. And this probably gives the best indication of what the difference between supply and demand is and why there is like this wider price pressure that we see across oil at the moment. So if we look at exports on the left-hand side, if we look at world oil exports across crude and products, we've seen a steady rise since the start of the year. We've seen increases in diesel exports, we've seen increases in crude exports as well at a global level. And actually that figure as of November is at the very edge of the 5-year range. So really pushing the limits of what we've seen in the past. However, if we look at things on the import side, the picture is very different. Current world oil imports are well within the 5-year range. and they look flat, and there's every risk, given what we've heard in the past from David about recessionary risks and demand risks, that this could also trend lower as well. So this disconnect between export activity and import activity is really diverging, and so that's really putting pressure on prices. So with that, I'll pass over to Dylan, who can kind of talk a little bit more about what we're seeing with Russia.
Thanks, Jay. Yeah, so just want to show from a freight perspective how things have been changing recently, and also since the conflict in Ukraine started. From both charts, the first thing that you notice is that there's an increase in the number of vessels leaving the Baltic, and that means an increase in the number of vessels that are needed for Russian crude exports. And that is mainly a function of how much further they have to travel to deliver crude, because as they head less and less towards Europe and more towards India and East Asia, then the turnaround time increases, and so you need more vessels. One other thing you notice on the right-hand chart is the introduction of way more Suezmax tankers, where traditionally Aframax tankers are used for Baltic crude exports. Now, this could be because Suezmax tankers are cheaper, but what's more likely is that since you load a similar amount onto Suezmax tankers as you do Aframax tankers, it's just a case of Russia using any vessels that they can really get their hands on to move crude out of the Baltic. On the left-hand chart, another interesting thing that you notice is this increase in the yellow line of older tankers being used. And now that's made up of Aframax and Suezmax tankers, but older tankers tend to fix at lower freight rates, and so that helps with the cost effectiveness of these crude exports. I'll hand over then to Jay as well to tell us more about what we're seeing in the Baltic and Black Sea.
Thanks, Dylan. So obviously the December the 5th deadline has only very recently passed, but it makes sense to look at what's happening with tankers loading from Russian, Baltic and Black Sea ports around these dates, just to give an indication of what could happen in the future. We're still very much in a discovery and a learning phase at the moment, but there are a few interesting things we've seen in each region. So starting with the Black Sea on the left-hand side, what we've seen is that crude tankers loading from Russian Black Sea ports, they have had difficulties in crossing the Bosporus Strait. So since the 28th of November, we've actually seen no crude tankers cross these straits, and we've seen a little bit of a congestion build up just outside. And so we see at the moment around 15 tankers waiting to pass through the straits. And the reason for that is Turkish authorities are requesting documentation, proof that these ships have cover to cross the straits, and so they have the ability to do that, and that's causing this kind of build up in tankers. Most of this is affecting CPC blend cargoes. However, there are some Urals cargoes which are on their way at the moment, so it's definitely one to watch in the coming days. If we move over to the Baltic Sea on the right hand side, what we see is that most of the ships that have actually loaded since the 1st of December, they're actually generally pointing all towards India. That seems to be the main discharge location for the ships that have loaded most recently. However, there are a few ships which we've circled here, which we just want to point attention to. So there's two ships highlighted in blue, and the reason they've been highlighted is because they're showing for potentially STS discharge. So they may not head directly to India. Instead, they may do an STS discharge onto another ship. We think potentially a VLCC on offshore the North Atlantic, and Armin will talk about that in the following slides. But nevertheless, yes, most of these ships seem like they're heading towards India. The other interesting tanker to talk about here is the one mentioned in red. And the reason for that is that ship is actually 20 years old. So it's really pushing the edge of what's normal for ships loading in this region. As Dylan mentioned, the use of older ships to load from Russian ports is something fairly recent, and 20 years is definitely at the extremity of things. So possibly this is something we will see more over in the coming weeks.
Now, speaking of Russian crude buyers, Chinese refiners and traders have accelerated Russian crude liftings before the December 5th deadline, especially from the Russian Far East side. We can see from the left chart that during the last week before section kicked in, loading rate of export blend jumped to a new record. So the Chinese buyers will continue to receive a big number of export cargoes in the first half of December. But loading from Russian Far East is likely slowing down after December 5th, or even taking a pause for now, because the logistics seems yet to be solved if the cargoes were sold above the $60 cap. We have observed vessels going dark at the moment. And buyers, especially Shandong Teaports refiners, who always buy on a delivered basis, are demanding deeper discounts than in November. I think we will see a clearer picture there in coming weeks. And on the Russian Baltic side, from the right chart, which is a screenshot of our live map taken on Monday, we can see that there are very few Euros on the way to China than in previous months, despite more vessels ballasting to Baltic Sea in recent months. Again, logistics is the main issue here because the flagship grade Euros crude is already loaded within the price cap, but freight rate towards China is flying sky high, making the overall cost to end buyers uncompetitive to other crude grades such as Iranian light. So it seems that the key players are not in a hurry to show cards, and ultimately the decision on whether China will take more Euros will likely fall on Beijing's decision. Now I will pass on to Armin for more sanction flows.
Thank you, Emma. So if we look at Iran, Iranian crude and condensate exports actually surpassed 1.2 million barrels a day in November. And this is actually a record high since sanctions were imposed back in May of 2019. And really this significant increase we're seeing is also continuing in the upward trend observed in October, and really a rebound we've seen from the 2022 lows given the stiff competition faced from Russia. Then this recent increase in surpassing record highs is really driven by price. So Iran has actually heavily discounted their crude in the recent 5 to 6 weeks, hence the higher induced demand from their biggest buyer, which is China. And the second reason for this is also stock draws. So although Iranian crude production is flat at the moment, I believe currently sitting at 2.5 million barrels a day, we've actually seen quite large stock draws given by the yellow line on the left-hand chart there, where they've seen 2 million barrels drawn from October through November. It's also helping them facilitate higher exports. And then we look on the import side on the right-hand chart here, we can actually see from the yellow line, Iran's share of Shandong crude imports has actually significantly risen, whereas the share of Russian share has actually fallen at the same time. And it really highlights how price is a really large driver for this. And also we mentioned that these barrels are really going into bonded storage in China at the moment before they head to their final refinery purchases. One last thing to mention on this slide is tanker supply. So again, through 2022, facing stiff competition from Russia, another factor for this has been tanker supply, and that tankers have been switching from Iranian trade to Russian trade. But in recent months, we've seen actually 10 tankers newly join the Iranian trade, helping them facilitate higher exports. And we believe that the fact that they're exporting so much might allow them to free up more tankers to join the Russian trade in the near future. And on that note of tanker supply, I think it's a nice slide into the next slide here, talking about VLCCs. Thank you. Yeah, so if we look at VLCCs here, earlier this year in Q2 and early Q3, we saw a phenomenon whereby VLCCs were loading Urals via dark STS transfers within the Atlantic. And it's interesting we're seeing now is that those same VLCCs are actually ballasted back to the North Atlantic from China for what we believe to be around 2 of the same activity. So in those orange circles you see on the screenshot, we have 2 tankers, the Lauren 2 and Progress V. They discharged their Urals in China in early September. and they returned to this location in mid-November, and they've been there since. Again, towards the bottom of the chart, those two red circles, Monica S, Natalie, and 7, again, VLCC did this activity a few months ago. They're heading back to the same location, and all 4 of these will be joining a 5th tanker, Crystal Rose, in the blue circle, which all seem to be based on AIS, still in this location, with no draft updates as of right now. So something we'll be monitoring very closely moving forward, and it really highlights the logistical constraints facing loading Russian Urals heading further east. But again, something we'll be monitoring very closely. I'll now head it over to Dylan and talk about freight rates. Thanks.
Thanks, Armin. So yes, I just wanted to talk about crude imports to China. On the left-hand side, what you can see is these 4 months of strong momentum that we've seen consecutively. We've also at the same time seen increased refinery run rates as the high product export quotas came into play. And what we do expect, though, is that this momentum will abate somewhat in the months to come. And there's a few factors behind that. So first of all, the import level is really high and is evidently quite unsustainable. And one of the indicators here is that, and on the red line, you can see a build in China's crude inventories. But then there's also this prospective cut in production product export quotas that we might see going into 2023, as it's not likely that we'll carry over these high product export quotas for the same period. But what we also see, which is the most telling indicator, is on the right-hand side, the VLCC freight rates towards China that have been softening after months of continued momentum. And so that's why we're expecting this momentum to decrease. Of course, there is also this caveat that we can always see a surprise, I guess, from China in a policy change, and they could surprise us to the upside. And we could actually see a return in activity, but the data at the moment is pointing to a slowdown. I'll pass on to Serena to talk more about Asian refineries.
Yeah, so looking at the wider Asian refinery runs, indicators are showing that the Asia's refinery runs have likely peaked in November, and the softening demand outlook that we're seeing could potentially prompt the refiners to scale back their runs in the first quarter of 2023. Now, in the recent months, especially in November, while we see higher crude imports into Asia, the incremental supplies have headed into the onshore crude storage tanks, as we see on the chart on the right. And this has told us that in terms of the implied refinery utilization, it has remained relatively flat on a month-on-month basis compared to October. Now, if we take a step back to understand the key market drivers, it doesn't surprise us because on the one hand, the two key drivers that have been really keeping the Asian refinery runs really strong is, first of all, the very strong pull to the west, especially for diesel. And second of all, the relatively robust regional demand, and especially coming from Australia. Now, if we look at the recent months, the east-west diesel arbitrage has narrowed significantly such that it probably becomes very not uneconomical for Asia diesel barrels to head towards Europe amidst ample supplies. And on the other hand, in terms of the second factor, the regional demand has softened by quite a fair bit. So because of these two bases, we started to see refining margins soften. And looking at the near-term horizon, it becomes unsurprising that refiners could be looking at run cuts heading into the first quarter of next year. Dylan, what's happening in terms of the implications for the crude tankers on the supply side of things?
Thanks, Serena. Yeah. So in this slide, I just want to point out the freight dynamics that are behind the freight market going into 2023. So on the left, first we'll start with supply. Basically, what you see is a sharp drop-off in new deliveries that we're expecting in the next 2 years. And so that means that the fleet is growing at a lower rate, and so there's naturally more tightness in the tanker market. One of the reasons for these lower deliveries is because of container ships and dry bulkers taking up space in the shipyards, but also because of the recent volatility in freight markets. ship owners have become a little more reluctant to buy new ships just because of the uncertainty in the market. And so that is also causing sort of less buying activity on the tanker side. On the right-hand side, what you see is steadily increasing utilization of crude tankers. And that's a function of how far tankers have had to travel in general, given the new routes emerging because of the Russia-Ukraine conflict. And so one thing as well, although the raw numbers of utilization are high, it's also about the percentage of the fleet being utilized. And for VLCCs, it's even up to about 90%, which is also causing tightness in the market with the increased demand as well. So going into 2023, the crude tanker market has a strong position and quite some momentum in terms of demand. But there is obviously this risk that the tanker market faces of easing demand in 2023 due to recessionary fears. And so what we could see then is that percentage of the fleet start to decrease, and that will alleviate the tightness in the market as well as cool the demand. And so we could see a softening in the crude tanker market if that all comes into play as well next year. I'll hand that back to you, Serena, to talk about diesel exports.
Thanks, Dylan. Now, if we shift our attention now to the clean market, looking at Asia's diesel exports, we all know that the strength in terms of the pull of diesel to the West, coupled with the strong domestic demand in the region, has really lifted Asia's diesel exports all the way up to November. But this could potentially change, and we'll talk about this in the next slide. And looking onto the chart on the right, what's really apparent is that, especially if you look at the red line that shows the current year, and we compare that against the 5-year average. For this year, the refined product exports coming up from the wider Arabian Sea, and by this we mean the regions in the Middle East, East and South Africa, and West Coast India have really skyrocketed above the 5-year range very quickly from the months of January all the way to June, but also it's now softening very quickly all the way back to the 5-year average range in October. And this is because of a couple of reasons, especially for India, the very strong domestic demand, some of the refinery maintenance that was delayed from the March period all the way to the September-October period has been one of the key drivers that has been causing or resulting in the decline in terms of refined products from this region. Now, what's really interesting also is to look at the splits in terms of where Asia's clean product flows have been going to. Now, if we look at the recent months on the chart on the left-hand side, we have started to see a rise in Asia's clean product supply staying within the region. As I've mentioned, the east-west arc, especially for diesel, as well as jet, has started to narrow quite significantly in the recent month. And also, we see relatively robust demand within Oceania, particularly from Australia, and that has kept more barrels within the region. But also surplus within the region has started to increase, and we see that coming from Singapore's clean product inventories, which is the line in light blue, rising. And that really speaks of more surplus within the region. Now, if we look at Asia's clean product exports to the West and looking at the breakdown by the destination regions. Now, first of all, if we look at Europe, there has been a sharp rise in Asia's clean product exports, particularly coming from India, to a certain extent Singapore and South Korea, towards Europe, and which has kind of peaked in October and started to see a decline in November. But we think that in the months and the weeks leading up to 5th of February, with the reshuffle of the Russian diesel away from Europe towards the rest of the world, we could potentially see some support of more Asian diesel barrels again heading towards Europe. Now, for the rest of the regions, especially if you look at Africa, Middle East, as well as others, it remains relatively range-bound, so we don't expect much movements from there on. Now, with that, I'm going to pass on back to Emma. What's happening in terms of clean product exports for China?
Yeah, so Chinese refiners have boosted refining run rates and maximized diesel yields since September, as in response to the very unusual extra product export quotas. In November, China's clean fuel exports, which represented by gasoline, diesel, and jet, sit at near 6 million tons. the highest since April 2020, while December exports are expected steady or higher according to our flow data and refiners' export plan. This suggests that refiners need not only to maintain strong production in December, but also continue to export at current rates till at least end of January of next year to make full use of the additional quotas. And from the right chart, we can see diesel leads the increase with a new record seen in November. It is worth to note that the majority of the diesel exports stay in east of Suez, and very limited supplies go to Europe because only a few Chinese refiners can make European winter spec diesel. Looking forward, the product export quotas for 2023 will likely scale back to the levels seen in the first half of this year. In that case, refiners may have to cut refining run rates in January, and because domestic diesel demand is seasonally weak during the Chinese New Year holidays, although the recent COVID policy shift may support some gasoline and jet demand during the holiday. Back to you, Serena.
It's me, I think, coming in here, but you have just given a quick answer to one of the questions. So basically, the recent changes in the COVID policy, how much of an impact do you see? You mentioned some upside for gasoline and jet. You didn't get my question, I guess. Anyway, let try me to say a couple of words on that as well. I think it's important to note that the Chinese economic problems are not just a function of the COVID situation. There are structural problems beyond that. There is this property bubble. There is simply demand situation. So the charts I've shown at the beginning and the one from Serena, Southeast Asian demand, simply shows that there is a slowdown in economic activity in the entire region. So China will have a tough time to sell its products to foreign markets as well. And then there is a policy change going on basically in the US and to a certain extent also in Europe, that this massive dependency that exists in certain markets of consuming countries on China, on Chinese goods, is targeted to be reduced. So there are multiple challenges for the Chinese economy, and we would generally be cautious to expect a big recovery in China's demand if just basically the COVID situation improves in the country. And we still have to see basically what is the effect of this relaxation, whether it's actually positive or whether it can lead to a backlash as well if there's then higher infection rates and basically a move back to stronger controls. Yeah, sorry for this short excursion. Let's move back to the diesel market. What we see on this slide on the left-hand chart is a pretty wild swing in net imports of diesel into the wider Northwest European market. So you can see that in difference to the Southern Hemisphere markets I've shown before, the spike in European diesel imports really occurred only in October, but it has really been a pretty substantial spike. But then in November, we have here a complete turnaround of the net import picture. The reason for that is on the one hand that imports also from European countries have come down quite significantly, but the other big factor is that Russian exports via Primorsk in the Baltic area, which is part of this region, have increased substantially. So basically what is happening that both sides, Russia and the European buyers, make use of this delayed import ban for refined products for the up to the 5th of February. So generally speaking, I think it was a smart move of the European Union to do these import bans in step, start with crude and wait with diesel basically after the peak winter months are over. So that's also one reason why the supply situation and the supply-demand balance basically for diesel is now looking much looser. As Serena said before, basically arbitrage windows are currently closed from all locations, from Singapore, from the Middle East, from the US Gulf. So at the margin, Europe is currently not calling for additional diesel. I think we shouldn't expect necessarily this to go on like this. So there will probably be stronger periods again down the line, especially once Europe really is replacing this Russian diesel. The point here is that in difference to crude, where Europeans have been facing back Russian crude imports steadily over the last 6 months, for diesel, it really looks like that they're waiting to the very last day. Yeah, so basically we will have then in late January a situation where Europe stops taking Russian diesel in one big go, and Russia has to look for alternative outlets at the very same point of time, and that has still some upside potential for diesel cracks. But generally speaking, we judge the global supply situation for diesel to be ample. We see here on the right-hand chart in the blue bars how massively diesel liftings have gone up globally. So you see in the left-hand scale from the beginning of the year, actually, it's even something like 1.5 million barrels per day of additional diesel liftings. And at the same time, all other products have been moving sidewards or downwards. Yeah, so this is a reflection of refiners around the world increasing the diesel production massively while cutting back on the other product yields. And now we are basically in a period where refiners around the world are pretty much running flat out. Yeah, we have moved post-refining maintenance periods in most markets. There are also no particularly big outages at this point of time, and there is new refining capacity starting up as well. So overall, the supply side, I think, looks pretty encouraging. We have also seen that the wider Arabian Sea region is not exporting that much product at this point of time, so there is definitely some upside there as well. So everything together, we think the times of extraordinary high diesel cracks and extraordinary refining margins are over, and the global refining sector will move into a weaker period next year, especially after the winter, the key winter months are really over. And we will see in all likelihood again the need for refinery run cuts, economic refining run cuts, as demand is simply not sufficient. Now, to come closer but surely towards the end of the presentation, following up on this topic, was how are refiners coping with the lack of Russian residues, especially in the US and Europe?
Thanks, David. So yeah, I mean, Russia's keeping everyone busy. In addition to all the products that you guys spoke about, when it comes to fuel oil, so the US, so for example, the US has banned Russian oil imports since April. So we've now had a bit of time to kind of like dissect exactly what's been happening there. And as it turns out, the US was very successfully able to sort of replace or find alternatives to this Russian fuel oil imports that it used as, primarily as feedstock for its refineries, secondary units. A lot of the supply, as we can see, came from Latin America, the Middle East in particular, but also to some extent Europe, and to a lesser extent places like Africa and sometimes Asia. So in coping with the ban on Russian oil imports, it also appears that the US had briefly upped imports of heavy crudes. These are heavy crudes, of course, have higher fuel oil cuts. Immediately after the April ban, once everyone was basically shuffling to find out what's the best way to respond. But those imports have very quickly since then come back to normal levels as refiners adjusted their operations and basically adapted to the new reality. Over in Europe, however, I mean, we're obviously already seeing signs of structural decline in fuel oil imports, and a lot of this is coming from the absence of Russian supply. However, the ban is not mandatory yet in Europe. That those rules kick in April, and a lot of these are voluntary sort of boycotts. But so like the US, Europe has been importing less fuel oil from Russia. But unlike the US, Europe is already importing a lot higher volumes of heavy and medium crudes from alternative non-Russian sources. Of course, a lot of these volumes are being used to basically replace your traditional Ural supply. However, these volumes also allow domestic European refiners to maintain a high level, some level of fuel oil output domestically, which they can use for their bunkering markets for refining feedstocks and so on. So over the near term, obviously we can see that European imports from Russia are likely to increase ahead of the February ban as buyers basically snap up as much as they possibly can before the ban comes into effect. But once that happens, it's likely to go down to or near zero, and then that's going to force basically enhance an already global shift in trade flows, as the next slide will show you. So here, I mean, another month passed. November was just concluded not too long ago, a week ago, and here is just a perfect example of how what a massive shift in Russia's fuel oil exports. Of course, Russia being the world's largest exporter of residual fuels. So there's clearly been a shift away, since the war began, away from Western markets towards the East. It was quite interesting to see that. So export or imports in the West from Russia have hit a record low in August, but since then they have sort of rebounded, and this is mainly led by imports into Europe. However, of course, these imports into Europe are still at very low levels compared to pre-war imports. Something like 70% down to pre-war levels. And of course, the East has been basically the new home for Russian residual fuel exports. And in the East, I mean, primarily this is Asia and the Middle East. Within those, it's Singapore and India and China, as well as the UAE and Saudi Arabia. In November, however, we saw kind of like this pause in this relentless growth of imports from Russia, and we believe that to some extent this was a slowdown in demand. There was some weak bunker sales being reported in Asia, for example. But going forward, I mean, especially as the ban on European imports from Russia comes into effect, we expect this trend to continue and is more than likely to hit fresh record highs in the not too distant future. And then if we take a closer look at the Singapore hub, basically the world's sinkhole for fuel oil. So over the past 4 months, we've been seeing ARBs or imports into Singapore trending lower. This is on the back of weak arbitrage economics and high freight rates, which have sort of kind of made arbitrage uneconomical. The lower inflows have supported prices in recent weeks, but this has also been counterbalanced by an expected slowdown in seasonal bunker demand and limited demand from utilities regionally. And as you can see, the inventories have both onshore and floating in and around the Singapore hub have been maintained at steady levels. In floating inventories, which we track, we're seeing high sulfur fuel oil inventories actually retreat from record highs of almost 1.5 million tons in mid-October. Of course, a lot of these volumes were coming from Russia, or directly or indirectly. And most recently, they came down to about 1.2 million tons, as imports from Russia, again, took a breather, as we saw on the previous slide. But in contrast, floating low sulfur stocks have been climbing higher in recent weeks. And this is thanks to, for example, increased flows from Brazil after refineries there concluded their turnarounds, as well as higher regional supplies on the back of weak light distillate margins or gasoline margins.
Thanks, Ross. And as we draw the webinar to an end, just to distill down the key takeaways. Now, what we're saying is that when we look at the global trade flows and the price signals, all these indicators are telling us that global oil demand is actually slowing pretty significantly. And as we head into next year, we expect that this trend will continue. But looking from a crude supply perspective, the growth in terms of the crude supply coming from the Atlantic Basin is leading to a global oil stock build and is putting downward pressures on the oil prices. But of course, there is a wildcard as to how much OPEC Plus could potentially continue to scale back in terms of their crude production to rebalance the oil supply and potentially keep oil prices at the price levels of between $70 to $80 per barrel. From a Russian oil exports perspective, we see that the Russian crude trade is now migrating to a second-tier fleet with illicit activities potentially happening. And it still remains very much an uncertainty and an unknown as to whether there is enough tanker supply and buying interest to keep the Russian seaborne crude exports at the same levels as before the EU ban has kicked in. From a China perspective, in the recent months, we did see an increase in terms of crude imports and product exports from the country off the back of increased quotas given by the government to boost the overall economy. But now we're seeing an inflection point where this is falling. And while there is good news, definitely looking ahead or towards China's potential reopening, but we expect that this reopening will be a phased as well as a cautious one. So demand recovery may be gradual. From a clean products perspective, looking at diesel import demand, diesel was really the brightest star across the barrel in terms of cracks this year, but this has slowed significantly because of ample supplies in the market. So we're saying that the peak tightness in the market is really over, and the market needs to find a price equilibrium to ensure that there is sufficient supply globally, as well as the pull of barrels from the east to the west, especially after the EU ban on Russian oil imports kicks in. For all the other products, the market looks fundamentally well supplied. So from that perspective, margins and cracks will remain relatively weak. And we could, from this perspective, see that refining runs next year will start to see a scale back. And with that, we can move into the Q&A section. Hey, David, do we have any questions coming in from the floor?
Yes, we do. I will start with one by Emma. Emma, do you see Russian oil going into Chinese SPR?
Actually not. Most of the Russian oil are going to refiners, and a few of them are putting commercial tanks, and we don't really see a build up in SPRs with Russian oil.
Thank you. Quick question for Jay. How do you see refining startups in the Middle East? What is the latest trend there?
David, yeah, so there are a couple, actually 3 interesting refinery startups that we're watching within the team here. So one is obviously the Jazan startup, and according to what we see and what we hear, the ramp up rates there are around 70% or so. We're seeing diesel coming out. We've seen some fuel oil come out. However, the diesel that we have seen come out from Jazan so far has stayed mostly within the Middle East region. So that puts some suspicion into whether they're fully producing European spec barrels at the moment, but definitely one to watch. Another one is the Al Zour startup as well. And so we've seen some cargoes of fuel oil and some jet fuel cargoes head out from there. It's still within very early days, so we expect more shipments to come through, especially within the coming weeks. And then finally, another one, which is a smaller refinery, is the Karbala refinery in Iraq, and that's scheduled to undertake test runs at the moment, and that should reduce Iraq's gasoline imports, and so create a more net export position for clean products more generally within the region. So yes, there are definitely a few interesting startups within the region, and yeah, with our data, we hope to show those flows accurately and quickly as they do arise.
Thank you. Armin, one question for you. Iranian, you have talked about Iranian imports and exports, how they have been rising. What has happened to Iranian oil at sea? Is there any change going on there?
Yeah, so we should be seeing a reduction in oil in terms of floating storage. So we've saw floating storage increase, not for very large amounts in recent months. However, we sort of shift in the crude v condensate mix, because there was more Iranian crude in floating storage due to more Russian barrels heading east. And so Iranian crude is more in floating storage. But now we expect to see that decline quite significantly, given the heavy amount being imported into China in the recent month. So we do see that change happening there as well.
Yeah. So that is freeing up vessels as well for the Russian trade. Yeah?
Exactly.
As vessels stuck at sea.
And we could expect to see a further switch from Iranian trade to Russian trade. That's right.
Perhaps one question for Serena in the meantime. Serena, we have talked about weakening refining economics probably next year. Which players in Asia would you see as relatively most exposed to run cuts?
So I think that potentially, if you look at the refining economics, first of all, the simple refineries, they will be the ones that are most susceptible because their margins are naturally lower as compared to the more complex refineries. And where the simple refineries are actually located is actually in the Southeast Asia region. But one caveat is that these refineries may receive support from the government in order for energy security purposes. So their run cuts may be limited or range bound. So if you look at India, for example, India does have some support coming from the east, from the west, sorry, and that will probably prop up their refinery runs. So just to come to the point that potentially the most highest run cuts may come from China as well as South Korea, because these markets really rely on the regional market, and the regional market, especially if we are seeing a softening of demand, they could be the first to go in terms of cutting back on their refinery runs.
Thank you. I will try to take a couple of questions on some shipping aspects myself. So one question is basically about the increase in ton miles due to the longer Russian, to the reshuffling of Russian oil. So Russian oil going long distances to consumer markets and Europe buying long haul barrels, whether there are enough tankers. That's a very good question. This question can be asked both for the dirty fleet and for the clean fleet. Evidently, right now, the key question is the dirty fleet. We do think that the jury on that is still a little bit out, whether there are enough vessels. The point is simply that you need so much more vessels to make this happen than the simple Russia to Finland or Russia to Rotterdam trades we had in the past. There is the potential that ice class vessels could play a role in there as well if it is freezing in the Baltic. That is a question of the weather, evidently. We do think that STSs are needed to relieve the pressure on the Aframax segment. We have seen more and more Suezmax going into the Baltic as well to help out there. We think that it's too early to say whether there will be enough vessels. It's also, of course, the question whether the full pressure, so to say, of Russian exports will go on this non-European, basically fleet, so outside the price cap. At this point of time, I think it's fair to say that there isn't any clear-cut indication that anybody would apply the price cap. But I would also dare say it's still too early to say that it's definitely failed. I think there will be probably a lot of negotiations and so on going on in the background. Countries like China and India and perhaps also Turkey will surely ask for discounts, and it will ultimately be a question of whether the logistics are available, whether the price cap will be employed. There has been a question also whether we hear about European P&I companies moving to Abu Dhabi and other places. That's something we have not heard. So there is simply still the question of who is giving this ultimate insurance. And that's something, that is a big question mark. I mean, the point is simply, if there is any accident, now we have, in the past, we didn't have this 15 years plus tankers moving around the Northern European area. And now we have very old tankers there, and perhaps there are STS operations, perhaps not. They may be further south in the Atlantic, as Armin has pointed out, but there are numbers of risks. There are numbers of question marks, we don't have clear answers, but we do think that there will be problems and volatility down the line. Does anybody in the team have some answer to pick up? I'm taking another one. So basically, the question is about demand increase, forecast that demand will increase next year. and why we're talking about refinery run cuts. So first of all, yes, we have first to see whether this demand growth forecasts do materialize. Yeah, if you look back at the recent history, demand growth projections have always been too high and have been revised down steadily. And I think there is a good chance that the same will happen again. The other thing is simply that there is additional refining capacity coming in. Yeah, it will be a question of timing, but there is, as Jay mentioned, the Middle Eastern refining capacity. There is some refining capacity in China. In China, it will depend very much what the government decides to what extent the domestic refining sector is used for exports. But overall, we see clear indications. I mean, you just have to look at the current market. Yeah, evidently the market is currently oversupplied with products. Yeah, and that's before these new refineries are really starting up. And yeah, in terms of additional demand growth, I would be cautious. The biggest upside to demand is China, and Chinese demand growth will definitely be met by the Chinese refining system. Yeah, so that's no net call to the outside. And demand growth everywhere else, I think, will easily be much less than the additional refining capacity we will have in that market. Yeah, so that's why we see weakening there. Anybody on the team? Otherwise, any questions? I think I'm not seeing. Yeah. I think that should be it. Otherwise, Serena, any final comments from your end?
No, I think thank you all for joining. Once again, as a reminder, we'll be sharing with you the recording as well as this slide deck. Also, there'll be a short survey after this session, and we hope to be able to hear your feedback. If you're interested in our data and our product, feel free to reach out to us, and we're happy to give you a live demonstration of our product. If not, thank you all for joining. Have a good rest of your day. Bye-bye.
Thank you. Bye.